I greet you, ladies and gentlemen, this evening as I present to you some finer details about monetary policy. In my previous video, I briefly introduced the basics of monetary policy as part of our course outline or part of our module on central banking and monetary economics. So we're still looking at the first topic, which has to do with an overview of central bank functions. So in this overview, it is our desire to cover the basics of monetary policy instruments, and all of that. You realize that the content that I'm going to cover in this lecture will be sort of motivating for what we are going to cover in topic number 4. Of course, topic number 4 will be a bit rigorous, and the material that will be covered will be of an intermediate nature because we are going to use the IS-LMBP model. We'll look at the Mundell-Fleming model in order to understand monetary policy in theory and also in practice. So without much wasting of time, I'm going to share my notes. So what we want to look at are monetary policy instruments, but the content that I'm going to cover this evening is not restricted to just covering instruments, monetary policy instruments. I just want to do for a moment some housekeeping. So you realize that monetary policy has got a lot of instruments that are used, but I will zero in on the most important ones, the quantitative ones. So once more, I'm going to share my screen. So yesterday, I briefly mentioned these goals, monetary policy, but I repeated them in today's lecture so that we are in a position to remember what we covered. That the first goal is high employment or low unemployment. The second goal is economic growth. Third goal is low levels of inflation or price stability. The fourth goal is interest rate stability. The fifth goal is the stability of financial markets. The sixth goal is stability in foreign exchange markets. So I want to give monetary policy a working definition. Yesterday, we gave monetary policy a sort of a loose definition, but today we want to give monetary policy a working definition. According to the definition which I've compiled here, monetary policy is a set of economic policies that manages the size and growth rate of money supply as well as credit conditions in an economy. It is an important tool or a powerful tool to regulate macroeconomic variables such as exchange rates, the inflation rate, the level of investment and unemployment. These policies or policy instruments are implemented through different tools. which include the adjustment of interest rates, the purchase or sale of government securities or treasury bills, the operationalization of which is called open market operations, or OMO, and changing the amount of cash circulating in the economy, which is either the increase or the decrease of money supply. The central bank or a similar regulatory organization is responsible for formulating these policies. And in many countries, it is the central bank working hand in hand with the central government. Governments try to control money supply because most governments realize that economic growth is easily affected by inflation. So monetary policy comprises or consists of those government actions through the central bank designed to affect or influence the behavior of the monetary sector, which comprises the banking system and other financial institutions like insurance companies and so on. Those activities are affected by interest rates. So monetary policy is the deliberate use of monetary instruments, both direct and indirect, at the disposal of the central bank in order to achieve stability in terms of prices, in terms of the exchange rate, in terms of low unemployment, in terms of a balance of trade balance or a small balance of trade deficit and so on. Monetary policy necessitates the establishment of a relationship between monetary policy instruments. So if monetary policy instruments are implemented at cross purpose, one monetary policy instrument may cancel the effects of another monetary policy instrument. I can give an example. Let us assume, because of inflationary pressures, the government decides to increase interest rates in order to mop excess liquidity through increased savings. But at the same time, the government also avails cheap credit, maybe from international financial institutions through the banking system. If the government does that, the effect of credit which has been made available, maybe at concessionary rates through the banking system, would be either to increase money supply or to decrease the interest rate, or the interest rate, all other things being equal. So when we look at monetary policy, it can be either inflationary or deflationary, or expansionary or contractionary, or tight or relaxed. Contractionary monetary policy is implemented to trigger a decline in money supply so as to cap inflation or to reduce inflationary pressures in an economy. Expansionary monetary policy is used to stimulate economic activity, especially after a recession or after a period of depressed investment due to either an internal or an external shock, like the COVID-19 pandemic, for instance. It caused a recession in many economies or stagnation. So what are the monetary policy targets, including intermediate targets, operational targets, and so on? The monetary policy targets are your money aggregates, like your M1, M2, M3, where M1 and M2 are defined as narrow money, and M3 is defined as broad money. And then the other target of monetary policy are short-run and long-run interest rates, or rather short-run and long-run interest rate dynamics in an economy. the indicators or operational targets of monetary policy are the monetary base or high-powered money. 2, the short-run interest rate, which is the rate on the treasury bills or the overnight rate. The instruments, as I said earlier on, are open market operations. And as I said yesterday, the fractional reserve requirements or the reserves requirement ratio, operating band for the overnight rate, and the bank rate, which is the rediscount rate. How do monetary authorities choose to target variables? So there are basically 3 criteria that are used. Number 1 is measurability. It's imperative when monetary authorities are targeting economic variables that whatever they are targeting is something which is measurable. Inflation is something which you can measure. Interest rates are also a variable which can be measured. So you can actually measure both the trigger variable, which is the interest rate, and inflation, which is the variable which is meant to be affected by changes in interest rates. And then controllability. Whenever you institute a policy, whether it's macro fiscal policy or monetary policy, the government must trigger a policy whose consequences it is able to control. And then the other aspect is predictability. In as much as monetary authorities are able to specify or spell out all the key stages of the transmission mechanism of a certain monetary policy measure, it's important that monetary authorities are able to predict the impact of a certain policy instrument being implemented. Now, money plays an important role in interest rate and inflation dynamics in an economy. You can't divorce money from the interest rate and inflation. The government budget deficits also can be an influential effect of monetary policy. A budget deficit is a situation where government expenditure or expenditures are more than tax revenues for a particular time period, usually a year. Monetary policy involves the management of money and the interest rates. The central bank is the one which supervises or initiates and implements monetary policy in an economy. So back to bullet point number 3. You can see that a budget surplus is a situation where government expenditure is less than tax revenue. And the budget balance is a situation where tax revenue is equal to government expenditure. So when we look at central bank aggregates, you realize that the central bank is a bank of all banks and a public authority that regulates a nation's depository institutions. So we know that a central bank is not a bank where we can go and do retail banking. So interest rates are influenced by the central bank through the institution of monetary policy. So money aggregates. A long time ago in many economies, there was M0, but M0 no longer exists in most economies, including Zimbabwe. Whatever constituted M0, it's now under M1, and it's basically just your paper money and your coinage. So M1, which comprises of, or which includes this M0, it's actually notes and coins. But in the United States of America, M1 includes non-bank travelers checks and checkable deposits. And then M2, it is M1 plus money market shares, overnight repurchase agreements, general purpose, fund balances of broke money market, savings deposits. I've already taken into account the aspect of M1. And then M3, it's M1 plus M2 plus money market funds, certain agreements, large deposits of over 100,000 US dollars, euro dollar deposits, and so on. But these money aggregates, they differ from one country to another. The key thing to realize is that to the original or the base definition of money, which is M1, certain financial instruments are added until we add all financial instruments in the economy when we are looking at M3. So when we are looking at the monetary base, the monetary base is not just money supply, like money which is circulating in an economy, but it includes money which is kept in financial institutions, in vaults, and the money in circulation. So we add the money which is not circulating and the money in circulation. It gives us the monetary base. In other words, it's money supply plus money which is kept at the financial institutions. And this constitutes high-powered money. When multiplied by the fractional reserve banking ratio. Because what should be kept in banks and not be given to the transacting public or the investing public, it's reserves requirements, which are part of the architecture of any banking system that you can think of or that you can ever encounter. Near money consists of highly cashless but liquid assets, such as money market securities or instruments, savings deposits, time deposits, and mutual funds, which can be easily realized as cash. So these are assets which can be easily converted into cash. The tools of monetary policy, just to rehash them, we've got OMO or open market operations, the discount rate, and the reserves requirements. When we are looking at open market operations, this is the buying and the selling of government bonds or treasury bills by the Reserve Bank of Zimbabwe. When the RBZ buys a government bond, the bank acquires money which can lend out, and the effect is to increase money supply, and the opposite is true. When the central bank makes a loan to a bank, the loan is called a discount loan. The interest rate on a discount loan is called the discount rate. So that's why the interest rate of the central bank is called the rediscount rate, or just the discount rate, which factor I didn't explain yesterday since we were just introducing. So lowering the discount rate encourages banks to take out more discount loans, whilst raising the rate discourages banks from borrowing from the RBZ. Therefore, when this discount rate is lowered, money is injected into the economy. In other words, liquidity is increased in the economy. The raising of the discount rate takes money out of the economy, ceteris paribus. And then the reserves ratio is the percentage of deposits that banks, especially commercial banks, are required to hold as vault cash and not dish out in form of loans, not give out in form of loans. The lowering of this ratio means that banks can loan out a greater fraction of deposits. thus increasing money supply. And when this rate is raised, the implication is that money supply will be reduced or it will shrink, ceteris paribus. The most important monetary tool, policy tool, is open market operations, because it is the primary determinant of the monetary base and the interest rates that prevail in an economy. Open market operations, they normally occur at the initiative of the central bank or your reserve bank. In the case of the United States of America, you realize the Federal Reserve System, or the Reserve Bank of Zimbabwe, the South African Reserve Bank, you realize that open market operations are very easy to reverse compared to other monetary policy instruments. And then the discount policy primarily involves changes in the discount rate, like what I've already alluded to when I was explaining the previous slides. A rise in the discount loans adds to the monetary base, and the fall in the discount loans reduces the monetary base. And the only way in which discount loans can rise is when the discount rate is reduced. And the only way in which discount loans can fall is when the rate is increased. Given that this interest rate, called the discount rate, is like a price, and the quantity of loans, or the level of loans in dollars, either RTGS dollars or United States dollars, it's like your quantity. So when the price of that commodity, which is loans, increases, which is the discount rate, which is increasing, the quantity demanded by commercial banks reduces, and vice versa. So the RRPZ facility at which discount loans are made available to banks is called the discount window. The RRPZ can affect the volume of discount loans in two ways: by affecting the discount rate or by affecting the quantity of loans through its administration of the discount window. So if the quantity of loans is reduced, the rate automatically increases, and vice versa. Besides its effects on the monetary base and the money supply, the discounting allows the Reserve Bank to perform its role as the lender of last resort. The most important advantage of the discount policy is that the RRPZ can use it to perform its role of lender of last resort, especially if there is tight liquidity in the money markets or in the banking system, to stave off an unfortunate situation like a bank run or any other situation which may cause instability in the financial sector. The reserves requirements. This involves changing the reserve requirements, which affects money supply by causing the money supply multiplier to change. This can be readily seen when you examine the credit creation multiplier. A rise in the reserves requirements reduces the amount of deposit that can be supported by a given level of the monetary base and will lead to a contraction in money supply. Conversely, or on the other side, on the flip side, a decline in the reserves requirement ratio leads to an expansion in money supply, because banks can now loan out more money from the deposits at their disposal. The main advantage of using the reserves requirements to control money supply is that they affect all banks equally and are therefore a powerful tool. They are therefore a powerful tool. I'll rectify that. Small changes in money supply would be obtained by extremely small changes in the reserves requirement. The main disadvantage is that when this policy instrument is implemented, it may have an immediate impact on liquidity, leading to a fall in excess reserves, which may trigger a bank run if this low liquidity is a systemic problem in the banking sector. So you realize that in most economies, this strategy is actually rarely used by monetary authorities. So the goals of monetary policy, once more to rehash them, it's high employment, economic growth, price stability, interest rate stability, stability of the financial markets, and stability in foreign exchange markets. The goal of price stability is normally at cross purpose with the goal of interest rate stability and the high employment in the short run. Because when you try to reduce interest rates, it triggers inflation. And in most cases, the central bank would reduce interest rates in order to incentivize investment in the economy, so as to boost employment. But that adds to inflationary pressures because there will be easy money in the economy. So the central bank has to sort of balance if interest rates are raised in an economy to prevent inflation, this may actually raise unemployment in the short run. So because of that tension between interest rates and the inflation rate, the central bank always tries to strike a balance, as it were. So we want to look at expansionary monetary policy as well as contractionary monetary policy. To increase money supply, the RBZ can buy government bonds in the open market. This can be operationalized by lowering the discount rate or lowering the reserves ratio, or expansionary monetary policy can be operationalized by increasing money supply or lowering the discount rate or lowering the reserves ratio. All of these three policy instruments have got the effect of increasing money supply. When the economy is in a recession or experiencing a persistent unemployment problem, it makes a lot of sense to implement expansionary monetary policy. Changes in money supply affect the economy through a three-step process. The first step is an increase in money supply, which causes interest rates to fall in an economy. And this is analyzed diagrammatically, the next slide. The decrease in interest rates causes consumption and investment spending to rise, which leads to a rise in aggregate demand. Given that aggregate supply is fixed, an increase in aggregate demand causes real GDP to increase. So the first panel, where my case is over, has got it's money market conditions, where we've got interest rates on the vertical axis and loanable funds on the horizontal axis. So as money supply increases, the interest rate declines from where my cursor is to where my cursor now is. And the loanable funds that are demanded by private sector players, they increase. In general, liquidity improves in the economy, which leads to an improvement in aggregate demand, or an increase in aggregate demand from 81 to 82. Given that your aggregate supply, your short-run aggregate supply is fixed, we realize that the equilibrium level of national income increases from that point. It increases from that point to that point. But also the general price level increases as well. But it doesn't increase by a bigger margin like when we reach full employment, because here in this region are still below full employment. We attain full employment at that point, the full employment level of national income. So another way of looking at this is to incorporate the investment function, because it didn't exist in this panel on slide number 28. So we have got the interest rate and the amount of money demanded or supplied, which is just another way of saying loanable funds. If money supply increases from MS1 to MS2, whilst money demand is constant, we realize that the interest rate declines from R1 to R2, which is not labeled to that. And the effect of the decline in interest rate, according to the marginal efficiency of investment curve or the investment demand curve, is that the quantity of investment increases in the economy. There is a change in investment, a positive change in investment, which triggers an upward shift of the aggregate demand curve from 81 to 82, thus leading to an increase in national income from that point to that point, which is still below full employment level of national income. And the increase in the general price level generally, in terms of proportion, it's far much smaller than the increase in national income. So it's worth it to increase national income by this policy, which is triggering an upward movement in aggregate demand, ceteris paribus. And then when we look at contractionary monetary policy, this policy must by necessity decrease money supply in an economy through the selling of government bonds, which is an open market sale. Treasury bills are sold, or the raising of the discount rate, or the raising of the reserves requirement ratio. Contractionary monetary policy is appropriate when there is a persistent problem of inflation, where decrease in money supply causes interest rates to rise, thus mopping excess liquidity in the economy. And the increase in interest rates causes a decline in consumption and investment spending in an economy, thus dampening or decreasing aggregate demand, ceteris paribus. The decrease in aggregate demand has got the effect of decreasing nominal GDP or even real GDP. But it's a strategy of reducing inflation in an economy. In terms of this three-panel diagram, in the first panel, money market conditions are such that when we reduce money supply from MS1 to MS2, the interest rate rises from R1 to R2. And the amount of loanable funds that are demanded and supplied, they decline from L1 to L2. And this has got the effect of reducing investment because of an increase in the interest rate. When we look at the marginal efficiency of investment curve or the investment demand curve, and the net effect of this in the real goods sector or in the real economy is to cause a decline in aggregate demand from 81 to 82, which leads to a dynamic fall of national income from Q to QF, from Q to QF. And there is also a concomitant or congruent decline also in the general price level from P1 to P2. So I'm done with my presentation. In my next lecture, I'm going to be presenting on central bank independence. I will present a set of slides on central bank independence. I must be able to just give a presentation, just a single presentation on central bank independence so that we progress to topics like number 4 and number 5 up to number 7, which may be more demanding. in terms of intellectual rigor for some people that I'm taking for this course. So thank you so much for listening in to this recording. So in tomorrow's installment, I'm going to present on central bank independence and also central banking and the globalization of financial markets. So there will be two sets of slides. The slides for topic number 3 and the slides for topic number 2 and the slides for topic number 3, which I'm going to present. After I finish editing this current set of slides, I'm going to email it to the Master of Science in Banking and Financial Economics class that I'm taking this semester. This far no further. Remember to subscribe to my channel if you haven't subscribed to my channel, and also to disseminate this video on your social media handles. I appreciate those who are sharing this material on their social media handles. Have a good evening.